Welcome back to the channel. My name is Wade. In this video, we're going to be talking about what Tom Lee had to say about NVIDIA and the whole AI play as a whole. Tom Lee is a credible stock market researcher with an incredible track record. He has been right the last 19 months. So the guy is a wizard when it comes to the stock market. Let's take a look at what Tom Lee had to say.
Tom, great to see you. Long time no speak. First and foremost, what's your reaction to how the market is processed NVIDIA's numbers? It of course, fell initially in the pre-market. Yesterday morning, it was doing all right, and then it did close more meaningfully down by the end of the session yesterday.
Well, I think NVIDIA is one of these stocks that has become part of like a stock market lore. Almost everyone has a position, and I don't think the results and the earnings changed anyone's minds about AI and the central role it's playing in both global productivity, but also NVIDIA's role. But I think the sell-off tells you that a lot of good news was priced in. I think that's why the stock fell. It didn't take the broader market down. I think that was kind of a positive outcome, and I think it just shows you that there's room for a lot of rotation, and I think that it's revealing that small caps is one of the groups benefiting from that rotation.
Let's talk about that rotation, Tom, and the extent to which there's still a long way to go if you're looking at the valuations of some of those sectors that haven't done so well in recent months and years, or whether things have bounced enough across the board that you start to get a little bit concerned about valuations for the entire market, not just the NVIDIAs of this world.
Yeah, valuations are definitely something our clients are asking us about because, the equity markets have been rising for several years. But the idea of a rotation, I think, is grounded on a couple of things. One is that the Fed's rate path is lower, and that benefits cyclical stocks and small caps. And we know there's also a lot of cash on the sidelines, and investors de-risked because of the yen crisis and just general concerns about the summer. And so I think the NVIDIA results plus the Fed in September is really the catalyst that is going to get some investors to actually follow through with the rotation. So I think we're early because, for instance, small caps, I know people think they're expensive, but the median PE of a Russell 2000 stock is still 10.7 times forward earnings. That's compared to almost 17 times for the S&P. So the small caps have a lot of room for multiple expansion.
But Tom, do you want to just own the index? I mean, there's a lot of not great companies when you talk about small caps, in terms of not just their indebtedness, but any number of other metrics you might want to use. Are you telling people they should buy individual stocks or just buy the index?
I think it's both, David. We have a lot of portfolio managers that actually focus on small caps, and they're finding a lot of really attractive individual ideas with good earnings growth. But I think there is a misconception about the Russell 2000. I know there's many non-earners, but over 70% of the non-earners in the Russell 2000 are biotech stocks, and I don't think they're meant to generate earnings. And if you look at Russell 2000 earnings in aggregate, it rose 18% in the quarter, and it's projected to grow 39% in the third quarter. So in aggregate, it's not a bad index to own anyways.
Tom, I wanted to get your thoughts on the broader economic data. This morning, PCE came in line with expectations. We had GDP yesterday at 3% versus the 2.8% estimate. As we start to get ready for an interest rate cut, how much is already priced into this market?
We'll never know how much good news is priced in, but I think there was a lot of encouragement in both of the data points you point out. PCE core came in at 0.16. The upside driver there was actually financial services, which is because the stock market's up. It's showing up as inflation in PCE core. The year over year is staying at 2.5, 2.6, which means most people were thinking that year over year would actually tick up. They had negative revisions for the prior months. And on the inflation side, a 2.8 for UMISH 1 year, that's pre-pandemic levels of inflation. Consumers are always around 2.8, so I think this is giving the Fed a lot more green light to cut and focus on keeping the labor market strong, which means it's essentially acting as a Fed put going forward.
Just to give my take, I think Tom Lee might be right if we do not go into a recession. But as of right now, we need the Federal Reserve to cut interest rate quickly to prevent a recession from happening. Also, we do need to keep a close eye on new economic data coming in every week. That's all for the video. I'll see you guys in the next one. Be sure to check the description down below for some free stocks with Webull and Moomoo, who are sponsors of the channel.